Hello, everyone. Matt Somberg, partner and co-founder of Gottfried and Somberg Wealth Management. I hope you're well. Here we are the first few days of March and wanted to take a minute to review January and February and give you a few thoughts on some things going forward. All right, first, January was a positive month for the markets and February was a negative month for the markets if we're looking at stocks. The US stock market, in terms of the S&P 500, up about 1.4% for the first 2 months, and the NASDAQ, which is a little bit more technology oriented, down about 2.3. Stocks around the world, which have lagged for years, are up about 5.5% on a year-to-date basis. One of the things that we're always thinking about going into a year is that we expect at some point in time to see a market pullback. What this slide does here, the gray bars show you the annual returns of the S&P 500, basically for the last 45 years. And then each year there's a red dot below it, and the red dot is how much during the year did the market decline. So for example, last year, 2024, the S&P did about 23%, which is a great year, but we forget that there was a period of time last year where the market dropped about 8%, and that was a stretch from March into April in 2024. The average intra-year decline going back to 1980 is about 14%. So from a mentality standpoint, our expectation each year is there's going to be a period of time where markets decline. And should we or should we not, when we see that, use that as our entry point to be buying more stocks? We were sort of lulled last year into a very nice stretch of seeing the S&P 500 go up 9 out of 12 months in 2024. So that's certainly welcomed. Really, the worst month last year was April, where the S&P was down about 4%. And then a bit of a drop last year in November, sort of pre-election, market down about 2.4. But if we look cumulatively at what the markets have done, in this case, the S&P 500 going all the way back to January of last year, it's up between 26 and 27% over roughly 14 months, which is really nice. International stocks have always had a place in client portfolios. I would say they've been sort of looked down upon because they seem to have consistently lagged for years and years. But I did point out earlier that international markets are up about 5.5% this year. So it is nice to see that what is typically a smaller part of a stock portfolio is adding some additional value. The purple line here is historically what the S&P 500 has done, and the orange line are international stocks. So while there's been a little bit of choppiness with US stocks, it's been welcomed and nice to see international stocks doing well. So I think we have been witnessing a bit of leadership rotation in terms of where the gains of the markets are coming from. You've heard in our videos over the last couple of years the term the Magnificent Seven, which are the 7 largest American companies. In 2022, the S&P as a whole lost 18%. The Magnificent Seven, those 7 companies were responsible for about 11.7 out of the 18%. In 2023, the market as a whole did 26%. The Magnificent Seven, those 7 companies were responsible for about 16%, and the other 493 companies were responsible for about 10. Last year, 2024, total market gain 25%. Those 7 Magnificent Seven companies up 14%, the other 493 up 10. So you can really see 2022, 2023, 2024, 7 companies having a profound effect on the overall return of the markets. But we've seen some nice rotation. And so here we are in 2025. Those other 493 companies are up through the end of February, 3.4%, and those 7 companies down 2. So starting to see some nice gains out of the non-Magnificent Seven. And that's really going to be illustrated here when we look at sectors. Our economy is comprised of 11 sectors. Those sectors range from healthcare to financials to consumer staples, real estate, energy, materials, utilities, industrials, communications, information technology, and consumer discretionary. And what we've done here is pointed out to you where are those Magnificent Seven located. We've actually thrown in Netflix on top of that. That's sort of company number 8. And you can see year to date, Tesla and Amazon are down significantly. Consumer discretionary is the worst performing sector. Information technology, where you would find Apple, Nvidia, and Microsoft all down. So the categories that have been leaders over the last several years, consumer discretionary and tech, are actually the two worst performers year to date. We'll also point out that on the right, healthcare, financials, consumer staples, which are categories that in general are not as impacted by tariffs as maybe some other sectors are. Healthcare, financials, consumer staples are the leaders year to date. And you could come up with a theory that they're the leaders because those are sectors that historically are not really affected by trade wars or tariffs. In terms of the tariffs, certainly been in the headlines as we finished up February and into the first few days of March. Our observations is that these tariffs are ongoing negotiations, and whatever the headline is at 9 in the morning is not necessarily going to be the same headline when the trading day ends at 4 o'clock in the afternoon. But I think it is helpful to observe here and see what the makeup is of U.S. imports here in the United States. So Canada, China, and Mexico comprise about 43% of all products that are imported here into the United States. So less than half, which means that 57% of imports come from other places in the world. So certainly closely watching what the tariff negotiations are, or the trade negotiations are with Canada, China, and Mexico. But it's important to recognize that here in the United States, we get goods from all around the world. And it's important to recognize that the stock market is comprised of 11 different sectors. Some of those sectors could be impacted by tariffs, and many of those sectors would not be. In terms of volatility tied to tariffs, if we take a look at the purple line here, and we take a look at what took place in February with tariffs and trade wars in the news, it created quite a bit of volatility for stocks. Stocks during the month of February were down 1.7%, but bonds, which quite often are a safe haven for investor money when they're worried about the stock market or they're looking for less volatile, more stable investments, provided quite a bit of a buffer there. The bond market for the month of February is up over 2%. So one of the best months that we've seen for bonds in quite some time. A reminder, of course, sometimes we have to be not financial advisors, but psychologists, and sometimes clients will get quite worried about politics and how politics may or may not impact their portfolio. We love to reference this slide, which shows how if you only invest or only invested along party lines for a period of time, that would be the red and the blue line down on the bottom, compared to staying invested irrespective of party affiliation of the president. That has historically been the best path in terms of performance. So we're much more focused on corporate earnings. We're much more focused on economic data. We're less focused on whatever the headline of the day might be in the morning, especially if it could be completely different by the afternoon. So again, what do we pay attention to? First would be, how is the economy doing? That's gross domestic product. We've dismissed, of course, all those recessionary rumors that were supposed to happen in 2023 and 2024. GDP, gross domestic product, in the fourth quarter of 2024 was still quite good, over 2%, which shows that our economy is still doing well and growing. The unemployment rate, certainly in the news lately, has been the possible layoffs of some or several or thousands of federal employees, depending upon what the final outcome is there. But our unemployment rate is historically quite low, still in the low 4% range. You could make the case that if the unemployment was to increase, that the Fed could consider actually lowering interest rates, which could be helpful for the economy overall. But right now, the unemployment rate is still around 4%, which is quite good. Right. Inflation has continued to come down. We've looked at this quite a bit. CPI, if we take a look at Consumer Price Index in January, was right around 3%, which is a comfortable number. Many people would like to see it get closer to 2%. I don't think that's going to happen overnight. It would take some time for that to happen, but 3% CPI is certainly very reasonable. And down on the bottom of the screen here, the expectations are that the earnings of the companies in the S&P 500 are going to continue to grow, expecting sort of a 14% year-over-year earnings growth for the companies in the S&P 500, which means that companies are making money. and there's a reason in many instances to be buyers of the stocks of those companies. What has happened just very recently, which we think is very important to note, is that with this reduction in inflation and with some of the policy changes coming out of Washington, perhaps investors believing that inflation is coming down, there's been a noticeable drop in the rate on the 10-year Treasury. The 10-year Treasury is a government bond that helps investors understand what the market is thinking, where inflation might be heading in the future. And you can see really in the last 4 or 5 weeks, that rate kind of peaked out at 4.7. And as we speak to you today, it's down to 4.25. So that's helpful for any borrowing that our country does to be paying less interest. It's helpful for anyone who's borrowing money where interest rates are tied to the 10-year to see that lower rate. And it certainly indicates that the bond market is telling us that the bond market thinks that inflation is coming down and going to be staying lower. So that would be perceived as a positive for the economy as a whole. So a lot to digest in a very fast and furious January and February. We had a very peaceful 2024 with the markets being positive, 9 out of 12. We're now experiencing some volatility. A lot of it's tied to the headlines on trade and tariff. So we're digesting. We showed you the 11 sectors. Some could benefit from trade and tariffs, some could be hurt. But the best path, of course, is through diversification, which we wholeheartedly believe in. So we'll be back again with another update probably a month from now. Obviously, if you have any questions, and we know some of you do, don't hesitate to reach out to the advisor that you connect with the most. And we're happy to give you our 2 cents and try to give you as much objectivity and give you some additional information about what we're thinking about here at the office. So thanks very much, and we'll talk to you soon.